Good day, everyone. Today, we will discuss about the cash flow analysis. Now, income statements and statements of financial position are the most common financial documents available to the public. But managers who make financial decisions may find themselves at something of a loss if they only have these two documents on which to base their decisions for today and into the future. Therefore, managers also take a look at the cash flow statements. Okay, so happiness is a positive cash flow is certainly true. Although net income provides a long-term measure of a company's success or failure, cash is its lifeblood. Without cash, a company will not survive. For small and newly developing companies, cash flow is the single most important element for survival. Even medium and large companies must control cash flow. Okay. So, cash flow statement is classified into three. There's operating activities, investing activities, and financing activities. Okay. So in operating activities, the amount of cash flows arising from operating activities is a key indicator of the extent to which the operations of the enterprise have generated sufficient cash flows to repay loans, maintain the operating capability of the enterprise, pay dividends, and make new investments without recourse to external sources of financing. Cash flows from operating activities can be computed with the help of income statement of the current year, comparative balance sheets, and the relevant additional information. Okay, so there's inflows and outflows. So what are the inflows in operating activities? So these transactions, sales of goods, revenue from services, returns on interest earnings assets, returns on equity securities, receipts from contracts held for dealing and trading purposes, tax refunds, unless identified with financing and investing activities. These are all inflows under operating activities. So what are the outflows? These are payments for purchases of inventories, payments for operating expenses, for example, the salaries, the rent, the insurance, payments for purchases from suppliers other than inventory, payments for lenders for the interest, and payments for taxes unless identified with financing and investing activities. Okay. Now let's proceed to investing activities. So the separate disclosure of cash flows arising from investing activities is important because the cash flows represent the extent to which expenditures have been made for resources intended to generate future income and cash flows. So what are the transactions that would belong to the inflows under investing activities? We have sales of long-lived assets such as property, plant, and equipment, intangibles and other long-term assets, sales of debt or equity securities of other entities, collection of loans, the principal amount only, to others other than advances and loans made by a financial institution. And the outflows, acquisitions of long-lived assets such as property, plant, and equipment, intangibles, and other long-term assets, purchases of debt or equity securities of other entities, and loans, the principal amount only, to others other than advances and loans made by a financial institution. So please take note that the interest for the loans would fall under the operating activities, but the principal amount would fall under the investing activities. Okay. All right. Now let's move on to financing activities. So the separate disclosure of cash flows arising from financing activities is important because it is useful in predicting claims on future cash flows by providers of capital to the enterprise. Okay, so what are transactions that are under inflows of financing activities? Proceeds from from borrowing, like short-term and long-term. Proceeds from issuing the firm's own equity securities. And the outflows, repayment of debt principal, repurchase of a firm's own shares, payment of dividends, and acquisition of the enterprise-owned shares. Okay, so now, the content and form of the statement on cash flows. So a statement of cash flows for a period shall report the following. First, the net cash. So what belongs under the net cash? Provided or used by operating activities, provided or used by investing activities, and provided or used by financing activities. So we discussed on the prior slides the inflows and outflows for operating, investing, and financing. Okay, letter B, net effect of those flows on cash and cash equivalents during the period in a manner that reconciles the beginning and ending cash and cash equivalents. Okay, so this is an example of statement of cash flows. So there's the name of the corporation, and then the title, statement of cash flows, and then for the year ended December 31, 2012. All right, so there are three classifications under the cash flows. We have operating, investing, financing. Okay, and then the net cash provided, okay, so you add that up. So the net increase in cash, net increase because it's a positive. So that's positive 2,400. And then you add the cash balance in the beginning of the year. Okay. So the cash balance on January 1, 2012 is 10,900. So the cash balance end December 31, 2012 is 13,300. Okay. So here, investing and financing activities not affecting cash. So we have the ordinary issuance of ordinary shares for land and acquisition of land by issuance of ordinary shares. So there's no cash involved here. So that's why it's not affecting the cash. Okay. So this is how the cash flows look like. All right. Now, how to calculate cash flow from operating activities? So actually, there are two methods. We have direct method and indirect method. In the direct method, okay, this method, figures of income statement, example, sales, purchases, stock expenses are so analyzed to convert income statement based on cash basis. And in this method, cash realized from sales and cash paid for purchases and expenses will be ascertained. All right. So here are the adjustments to convert income statement amounts to operating cash flows using the direct method. Okay. So there's an income statement account here, and then what should be the adjustments? And then the cash flows from operating activities, and then the net operating cash flows. So if the income statement account is sales revenue, so you add if there's a decrease in accounts receivable, or you deduct if there's an increase in accounts receivable. Add if there's an increase in deferred revenue, or deduct if there's decrease in deferred revenue. So that's collections from customers. So these transactions, you label them as collections from customers in the cash flow. And that's the net operating cash flow, that's cash inflows from operating activities. Okay. Another income statement account is the interest revenue and dividend revenue. So you add if there's a decrease in interest receivable, or deduct if there's an increase in interest receivable. Add if there's an amortization of premium on investment in bonds, or deduct if there's amortization of discount on investment in bonds. Okay, so that's interest and dividends collected. and that's cash inflows from operating activities. Okay. So for other revenues, you add if there's increase in unearned revenues, or you deduct if there's decrease in unearned revenues. You deduct if gains on disposals of assets and liabilities, and deduct if investment income. So that's equity method. So that's other operating receipts and cash inflows from operating activities. Another is cost of goods sold. All right. So you add if there's increase in inventory, or you deduct if there's decrease in inventory. So cost of goods sold for merchandising, manufacturing businesses, merchandising businesses. So decrease in inventory. So for service business, there's no cost of goods sold. So plus, okay, you add if there's a decrease in accounts payable, or you deduct if there's an increase in accounts payable. So that's payments to suppliers. So that's cash outflows from operating activities. Okay. Now let's go to the selling and administrative expenses account. So you deduct if there's depreciation, depletion, and amortization expense. You add if there's a decrease in accrued expenses. You deduct if there's increase in accrued expenses, and you add if there's increase in prepaid expenses. You deduct if there's a decrease in prepaid expenses. So that's payments of operating expenses. Okay, so that's cash outflows from operating activities. Another income statement account is the interest expense. Okay, so you add if there's a decrease in interest payable, or you deduct if there's an increase in interest payable. You add if there's amortization of premium on bonds payable, or you deduct if there's amortization of discount on bonds payable. So that's payments of interest and cash outflows from operating activities. Okay. So for the other expenses account, you deduct if there's losses on disposals of assets and liabilities, and also deduct if there's investment loss. So that's other operating payments. So the net operating cash flows is cash outflows from operating activities. Okay. And for the income tax expense account, you add if there's a decrease in income taxes payable, or you deduct if there's increase in income taxes payable. Add if there's a decrease in deferred income taxes payable, or deduct if there's an increase in deferred income taxes payable. So that's payments of income taxes. So that's cash outflows from operating activities. Okay, now, as I've said before, there are two methods to convert net income to net cash flow. So the first one, direct method, and the second one is the indirect method. So this one, there's net income after taxes, and then you add these transactions, okay? The decrease in current assets, except for cash, marketable securities, and non-trade accounts. Increases in current liabilities, except for financing or non-operating accounts. Depreciation, depletion, and amortization expense, amortization of discount on bonds payable, amortization of premium on investment in bonds, increase in deferred income taxes, and the loss, the net loss on disposal of assets or liabilities, subsidiary loss under the equity method, interest expense, and income taxes. And then you deduct increases in current assets. Okay, so basically, it's the opposite of here. So in decreases, increases. Increases in current, decreases in current liabilities. So depreciation, depletion here, amortization of premium on bonds, amortization of discount on investment in bonds, decrease in deferred income taxes, gain, the net gain on disposal of assets or liabilities, and subsidiary gain under the equity method. And then that's equal to net cash flow from operations. Interest paid, income tax, interest paid and income taxes paid, and net cash from operating activities. Okay, so to better understand how to analyze the cash flow, or how to make the cash flow statement, let's have an illustrative problem. Okay, so the condensed financial information of the Kalikasan company for 2012 is shown below for the preparation of the statement of cash flows using the indirect method. Now let's prepare the statement of cash flows after completing the worksheet. Okay, so this is the information. All right, so the statement of financial position information. So we have here cash. Okay, here total liabilities. All right. Okay, that's for January 1, 2012, the beginning balance, and this one for the ending balance. And here's the income statement information for 2012. And this is the retained earnings information for 2012. Okay. All right. So here. Now this the supplementary information for 2012. Equipment was purchased for cash at a cost of 15,200. 10-year bonds payable with a face value of 8,000 were issued for 8,000 at the end of the year. Land was acquired through the issuance of 100 ordinary shares of 10 peso per shares when the stock was selling at a market price of 40 peso per share. Equipment with a cost of 2,200 pesos and a book value of 1,500 pesos was sold for 2,100 peso cash. So there's a gain here. So the worksheet for the preparation of the statement of cash flows and the statement of cash flows are presented below. So we have here the Kalikasan Company worksheet for statement of cash flows for the year ended December 31, 2021. Okay, so this one, all right, let us first focus our attention here, this portion. So we have here net cash from operating activities, okay, like our adjustments. So the net income, 8,400. So this data here, 8,400 was taken from the income statement, okay. So that's the 8,400 net income, okay. Now next, depreciation expense of 3,400. Okay. So there's a depreciation expense 3,400. Okay. Income tax expense of 100. Okay. So that's here. This one, 100. Okay. So it's an expense because the interest, okay, 700, that is greater than the sale on equipment. Okay, so 100, so that's an interest expense. Income tax expense rather. And then decrease in accounts receivable, 3,600. So there's an accounts receivable here. So 4,400 in the beginning. So you deduct the ending balance of accounts receivable, which is 3,600. So that's 800. Okay, so that's why there's 800 here. Okay. And then increase in salaries payable of 400. So salaries payable here from 1,400. So by December 31, it becomes 1,800. So there's an increase of 400. So that's why there's 400 here. Next is increase in inventory of 1,600. So the inventory is 5,000 in the beginning, and at the end there's 6,600. So there's an increase of 1,600. That's why it's here. And then we have decrease in accounts payable of 1,900. So the accounts payable in January 2012 is 5,100. And by December 31, that's 3,500. So that's 1,900, decrease. Okay. And then we have gain on sale of equipment of 600. Okay. All right. We have here gain on sale on equipment of 600. Okay. Interest expense of 100. Okay. Interest expense here. And then there's the income tax expense of 3,600. Okay. Now, so we have here the net change or worksheet entries for the account. So cash flow from investing activities. So payment for purchase of equipment. So that's 15,200. Okay. This one. Equipment was purchased for cash at a cost of 15,200. Okay. So that's a credit. All right. Credit because you pay cash. So you deduct cash 15,200 because you pay it for the equipment. And then proceeds from sale of equipment of 2,100. Okay, here was sold for 2,100. So that's a debit. Okay. And then cash flows from financing activities. So proceeds from sale of bonds, which is 8,000. Okay, so we have here 10-year bonds payable with a face value of 8,000. All right. Next is payment of dividends, which is 1,800. Okay, so that's payment of dividends here, less dividends payment. So you can see that in the retained earnings information, dividends of 1,800. Okay, and then issuance of ordinary shares for land, 4,000 you debit, and then acquisition of land, 4,000 you credit. Okay, so this is here, right? Land was acquired through the issuance of 100 ordinary shares of 10 peso par when the stock price was selling at price of 40 pesos per share. So that's 100 times 40. So that's 4,000. Okay. So there's a net increase in cash of 2,000. So there's a total of 27,100. All right. So, okay. So you put it here, this one. So your cash, so you debit 2,000. There's an increase, you debit. And then the accounts receivable, okay, credit 800. And then inventory, so 1,600. So that's here. Okay, and then 4,000, 15,000 for the equipment. Okay, you purchase equipment. All right. And then 2,200, credit 2,200 because you because of this one, equipment with a cost of 2,200 was sold for 2,100. So you record the 2,200, the cost here, the cost of the equipment. Okay. And then accumulated depreciation, 700, 3,400 credit, right? Accounts payable here, 1,900. So that's from here. Okay. Salaries payable, there's an increase of 400. The bonds payable, the ordinary shares. Okay, there's a total of 27,200. Okay, now here's the statement of cash flows for the year ended December 31, 2012. So this is the net cash flow from operating activities of 12,200. Okay, so you make the adjustments. Sorry. So net cash flows from operating activities. So net income before interest and taxes is 12,100. So where can you see the 12,100 from the income statement? Okay, operating income 12,100. All right. And then adjustments for differences between income flows and cash flows from operating activities. So you add the depreciation expense of 3,400 because depreciation is a non-cash transaction. So there's no cash involved there. And then you also add the decrease in accounts receivable of 800, increase in salaries payable of 400. Okay. And then less increase in inventory of 1,600 decrease in accounts payable 1,900, gain on sale 600, interest expense 100, income tax expense 3,600. So the net cash provided by operations is 8,900. So it's a positive amount. Now let's go to investing activities. So payment for purchase of equipment, 15,200. Okay. So you put a bracket here. This is an indication that you deduct this one, 15,000, and then proceeds from sale of equipment. So that's 2,100. Okay, so the net cash used for investing activities is 13,100. Okay, now let's go to the financing activities. So this proceeds from issuance of bonds, which is 8,000, and payment of dividends, which is 1,800. So the net cash provided by financing activities is 6,200. So the net increase in cash, okay, as seen in Schedule 1 is 2,000, right? As seen here. Okay. Okay, here, 2,000. Okay. So cash balance January 1, 2012 is 3,500. Okay. So 3,500 here in the balance sheet. Okay. And cash balance December 31, 2012 is 5,500. That's 2,000 plus 3,500. Okay. Or you can add 2, or you can have this one. Net cash provided from operations 8,900 plus, okay, negative 13,100, right? And then plus 6,200, so that's 2,000. Okay, here there's an increase in 2,000. So you sum this up. The net cash provided from operations, the net cash used for investing activities, and the net cash provided by financing activities. Okay, that's the increase in cash. And then you add that to the cash balance, and then you get the cash balance end. All right. So under the direct method, the net cash flows from operating activities may be presented as follows. So we have here cash flows from operating activities, cash inflows. So collections from customers, 80,000 plus 800. So that's 80,800. Cash outflows, payments to suppliers, 48,600 plus 1,600 plus 1,900. That's 52,100. Payment of other operating expenses. So that's 19,300 minus 3,400 minus 400. That's 15,500. And payment of interest expense, that's 700. Payment of income taxes expense, 3,600. So the total of 71,900. So cash inflows here, 80,800 minus the outflow of 71,900. So net cash flows from operating activities is 8,900. Okay, so this is how you make for the cash flow statement, right? As I have said, there's 3 classifications: cash flows from operating, investing, and financing activities. Okay, and then you get the sum of that. Okay, so that's it's either an increase or a decrease in cash or cash equivalents, and then you add the cash balance in the beginning, so you get the cash end. Okay, so thank you so much for listening, and I hope you learned something from today's discussion.